Hello, everyone. My name is Eric Gauss, Chief Economist of Dodge Construction Network. Before we begin, I'd love to share a little bit about Dodge, since some of you may not know that much about us. Dodge brings together the industry's most trusted data, research, projects, and planning intelligence. Our ecosystem supports architects, GCs, trades, manufacturers, and insights that help you plan smarter, win more work, and stay ahead of market shifts. So today we're going to be talking a little bit about the economy, broadly speaking, and what that means for the construction industry over the next several months to a year. Before we get going, you'll see the title slide, of course, and signs of a turn is sort of the way that I'm feeling at this moment. I've been fairly depressed most of 2025. It was a really rough year, lots of uncertainty. Not that that uncertainty has gone away, but we've started to sort of come out of this period where we've gotten to a place where, man, we all know that it's just going to be here for a while. And that always means that there's a possibility that things could be getting better. So the economic data is looking a little bit better, slightly. There's still some rockiness ahead, but and some reasons why it's hard to forecast what's going to happen in the next year. I'd like to talk through what my thinking is and the impacts on the construction industry. So there's, of course, been a pretty big change in the way that the economy has been sort of going through 2025. Prior to that, we were, of course, coming out of the pandemic. There was a lot of pent-up demand. There was, problems with supply chains. We had inflation. All of those things were sort of making things really rocky. And there are lots of structural changes in the economy. In 2025, we saw even more of that, and more structural change, basically brought on by policy changes through the executive branch of the government. This has led to a really wild swings in GDP in 2025, with, of course, that negative print in the first quarter as companies and people bought all of their imports ahead of the expected tariffs that then were announced in April. We've also had a big swing on the positive side as well. There was the AI capital expenditures, which has sort of boosted a lot of investment. And that investment has led to a lot of strength over the middle of the year. We're coming to a place where 2026 is looking a little bit better than we were thinking before. That helps a little bit over the next coming year, but there's a lot of uncertainty following the middle of 2026. Hold on just a second. My apologies. My 6-year-old son is ill and is home, and I had to take care of something for a moment. Turning to the job market, this is one of the places where we're seeing a lot of weakness despite a slightly strong GDP number. This is a lot by design. The Federal Reserve has had interest rates relatively high, given the high inflation numbers that we saw in 2022 and 2023. Those high interest rates have led to a cooling job market. So if you look at that brown line, you're seeing the 3-month moving average of changes in total employment. And those changes have been getting smaller and smaller every year, every month, and have actually turned negative over the last quarter or so. This, of course, gives economists a lot of pause, particularly when coupled with that blue line, which is the revisions that take place every month over the month. The way that the BLS collects this data is they produce a survey where they ask businesses to tell them how many people are on their payrolls. What happens during potential turning points in the economy, particularly if they're negative turning points, the companies that are struggling are the ones that take the longest to respond. And therefore, you get more negative revisions because they don't respond in the first month, they respond in the second or the third month. And so you get larger negative revisions. This is why economists have been very nervous over the course of 2025 about the potential for a recession. Thankfully, that hasn't happened, largely because as the job market, as the number of people employed has decreased, the number of people that are looking for a job have also decreased. So the labor force, the labor supply, has been decreasing at roughly the same rate. This is why, largely speaking, the unemployment rate hasn't been moving very much over the past year or so. That's a good thing that the unemployment rate hasn't been moving, but it makes us for a very nervous time. And it also makes it feel like there's a possibility of recession if just the right situation comes up. Economists like to sort of crystallize this information through a probability of a recession. My sort of favorite model, I do my own modeling for this. I take a bunch of economic data and financial data, and I sort of say, hey, what's the likelihood that there's going to be a recession in the next 12 months? And I use NBER, the National Bureau of Economic Research, recession dates. This is a committee of economists that sort of time when a recession starts and when a recession ends in history. I use this model. The light blue line is sort of my baseline model, and the brown line is one that includes an economic policy uncertainty index, which is basically looking at news and trying to figure out through sentiment analysis whether there's a lot of uncertainty around economic policy. I believe in the statistician's maxim that all models are wrong, but some models are useful. In this particular case, it's not so much the model itself, but it's the difference between these two models that I find particularly telling. If you look at the difference, there only really is a big gap in 2025 between these two models. And my argument here would be is that that gap is telling us that economic policy uncertainty is the most likely reason why we might, if we slide into recession, is likely the root cause of sliding into that recession. Why? Because when we get a lot of policy uncertainty, it causes people to slow down their decision-making process. I'll show you this later specifically for the construction industry, but you can see that sort of across the board. Firms weren't really making a lot of decisions. Consumers were sort of slowing down their purchases. And if you look at the Federal Reserve for a very long time did nothing. It didn't adjust policy for a very long time. Only in September did it start cutting policy rates again. So it took a while for people to get used to this new structure of the economy and the fact that they didn't know exactly what tariff rates were going to be and what immigration enforcement actions might mean for the economy. So you see that gap, and in my mind, that's the thing that makes me very nervous, is that uncertainty has stayed around for a while now, and that can be really problematic. Of course, tariffs and immigration enforcement don't just influence the real side of the economy, it also affects inflation, right? So the Federal Reserve, of course, is going to be really nervous about the fact that the economy has been slowing down, at least when you look at jobs. They're also going to be really nervous about inflation. And so you look here, the dark blue line is iron and steel. And of course, iron and steel prices have been going up over the past year. A lot of that comes down to tariffs being placed on iron and steel. You can also see that in final demand, the purchasing price index there has also been fairly robust compared to the prior years in 2024 and 2023. That is starting to tick up a little bit. That's going to continue to tick up as as those iron and steel prices and other sort of base products start to filter through the production process and start to lift those prices. And then, of course, that light blue line is the core PCE deflator. That is, in fact, the measure that the Federal Reserve, when they say we're targeting 2%, we're going to have that light blue line be what the Federal Reserve is actually looking at. Now, as you can see in this chart, and it looks like a whole bunch of spaghetti strings, but the reason why I like this is it helps you understand how the flow of the data sort of comes through. It takes a while for something really early on in the production process, like iron and steel, for the change of inflation in there to filter through to things like final demand and core PCE. So if you look at the change in the dark blue line in 2023 to 2024, you sort of see that mirrored through 2024 to 2025 in that brown line. Now, the theory, of course, is that that will eventually push its way through to that core PCE deflator. And in fact, we're sort of seeing signs of that move around a little bit now, right? So this is the part where we are starting to get concerned that there are going to be more price pressures coming through on the production side that will eventually reach consumers. The exact timing of that always changes, and so it's never really clear exactly when that will happen, but this is what the Federal Reserve is worried about and why they were willing yesterday to pause the cutting of rates, basically hold rates where they are, as they start to let the data speak a little bit more. Since they're being sort of pushed on two sides, the jobs market is slowing down, but there is this price pressure that's building for inflation. The Federal Reserve needs to be very cautious. If it cuts rates too low, they could aggravate inflation. If they keep interest rates too high, they could tank the real economy, the jobs. So the Fed is really nervous about this, so that's why they're going to sit pat. I expect them to sit pat for the first half of the year through the end of Powell's term, but we'll sort of see how that plays out. One of the reasons why this is particularly interesting in the current context is what is going on at the Federal Reserve in terms of the attacks by the current administration on the board governors and the chair himself. That economists refer to as Federal Reserve independence, and it's clearly under fire. This chart shows you the number of meetings between the Fed chair and the president. So this is sort of historically looking at all of that. The x-axis, of course, is the date, the year of those meetings. And what you'll see is a huge spike in the 70s. And this was when President Nixon was putting a lot of pressure on the Fed to lower interest rates. You'll also recall that during the 70s, that was sort of the height of the inflation problems within the US, and a period that we refer to as stagflation. Stagflation is a period where you have both a slow to recessionary economy coupled with high inflation rates. So what economists are very worried about, and why there has been a lot of pushback from the economic world against some of the actions taken against Federal Reserve employees, is that independence is going to be under fire. And if that breaks, it's been the cornerstone of economic policy within the US. It's one of the reasons why we've had such a strong economy for so long, and we really are nervous that that will create higher inflation. The thing that's kind of troubling about it is that the stated goal, of course, from the administration is to lower interest rates. Of course, what we really mean is lower the mortgage rate, lower lending rates to firms, and that sort of stuff. However, those rates are typically supported by whatever the federal funds rate, federal treasury rate is at, usually the 10-year yield. That's usually what people are using as their benchmark to sort of say how much risk they're willing to take above that 10-year. There's a good argument to be had that should the Federal Reserve lose their independence, the markets will actually assume that there will be higher inflation, like there was in the 70s when we had a lack of Federal Reserve independence. And the 10-year Treasury is part of the component of that is expectations of inflation. So if expectations of inflation are higher, we actually could see a higher 10-year yield, and therefore all of those interest rates on the long end, the mortgage rate and other rates, sort of commercial lending rates, those will also be higher. So we might actually get the perverse effect of going against the stated goal, which is to lower rates on sort of the broader economy. So this is an area where we're particularly concerned as economists, and we're paying a lot of attention to what's happening both in the courts and in those federal investigations of Chair Powell. This is also going to be particularly interesting because Jay Powell has the choice. His chairmanship ends in May. However, his term as governor does not end for another year and a half thereafter, which means most chairs have stepped down from their governor position as well as chair at the termination of their chair appointment. However, there is precedent. There has been a chair before who has stayed in their role as governor. And Jay Powell, the events recently actually makes it more likely that Powell will stay in that to fulfill that full term. And so that actually changes the composition of what the governorships might look like, and therefore actually lowers the sort of dovishness of the Fed going forward. So we'll sort of see how that all plays out. That's all going to sort of come to a head in about June. That's when the Supreme Court sessions are over. That's usually when a lot of their rulings come out. It's also when Jay Powell's term ends. And there are a handful of other things happening in June that are going to be really critical for sort of figuring out what's going to happen to the economy in the back half of the year. So given all of that information, the biggest risk that we face going forward is stagflation. So I have a tracker that I use to sort of keep me informed about what's going on with stagflation. So I want to look at what's happening with growth, and I want to look at what's happening with inflation. I have a lot of data that I'm looking towards to help me with that. We've got stuff that's telling us about prices, about expectations, and about wages. So when we think about inflation, the core thing that we really care about is that core PCE. But the CPI also gives us a read on what's going on there. We also want to know what's going on with expectations. We have two different measures of that. And then the critical part is whether we go into an inflation wage spiral, where when you get higher prices, employees ask for higher wages. When firms see higher wages, those are higher costs, so they raise their prices to offset those costs to maintain profits, and then you sort of run into this really, really pernicious cycle of inflation running away from itself. That's the thing that we're looking at to sort of see whether we should be worried about it. As of right now, I would say that things are okay. They've actually improved in terms of the direction that everything is heading. Everything's sort of moving sideways. However, there's still some reason to be a little bit concerned here. When we look to the growth side, I mostly look at jobs because that gives us the highest frequency, and it's a real thing that's pretty easy to measure as long as the government doesn't shut down and we can actually get that stuff going. Here, of course, the employment numbers are the thing that are giving us the biggest warning signs. That's the jobs data that I showed you earlier, which had turned negative. They're also heading in the wrong direction, which is also concerning. But if we look at things like layoffs and the unemployment rate, those are still sort of in the safe zone. The unemployment rate hasn't changed very much, and things are sort of doing okay there. Continuing and insurance claims are also okay, both initial and continuing claims. However, the data for insurance claims are, a little bit weirder to deal with these days because it doesn't seem to be sending as clear a signal as it used to. So that sort of gives us a sense of everything that's going on here. Those words there tell you about the level of all of these things, whereas the boxes on the side tell you something about the direction of travel. So red is sort of saying, hey, we're going in the wrong direction. Gray is sort of where is actually heading in the right direction, and that yellow is telling us whether things are sort of staying flat. So Generally speaking, we're doing okay. I'm a little nervous still about stagflation, and this is sort of what I keep checking on. It's something that if you see a lot of my presentations, you will see this pop up regularly. All of these things get updated on a monthly frequency, so I can sort of really get a sense of how that is sort of translating on a month-to-month basis. So, of course, what does that mean for the Fed? The Fed is looking at both of these things and worried about both of these things heading in the wrong direction. And that's why they have largely kept everything flat for a bit. I want to take a moment to talk through what my assumptions are about the Federal Reserve and cutting rates. They will be cutting rates, of course, this year. It's very likely, particularly if there are changes within the governorships. As I noted before, Chair Powell will be stepping down, and there will be a change in the chairmanship. What that looks like and how that influences the rest of the governors, we shall see. We do know that their target for what the neutral rate is, the rate at which we're neither trying to spur economic growth or to hold it back, is around 3%. That's generally speaking what people, economists have estimated that neutral rate is. And we expect that we'll get there somewhere in 2026. Okay, it's going to go slowly down throughout 2026 and get there by the end of 2026. Probably more on the back half than on the first half, but there's some debate depending on what exactly the data comes out on. The important thing to know is that even though those Fed funds rates are coming down, the 10-year Treasury, which is the brown line, isn't really going anywhere. That thing is just rock solid. And the main reason for that is, for right now, debts and deficits are high enough that there's very little reason for the long rate of 10-year Treasury to come down. The risk that is pretty palpable regardless of what's happening on the short end of the yield curve. And right now, we're not that far down below the 10-year Treasury. There's only a little bit of a maturity gap there. So we expect that that 10-year Treasury is just going to keep on hanging there a little bit above 4%. And that means things like the mortgage rate, which is that dark blue line, is going to be at its sort of historical norm, which is 170 basis points, or 1.7 percentage points, right? So that gap tells us something about what the risks are out there on the home side, and you can slip in any interest rate there, commercial lending rate. Same thing is going to happen. We're going to have additional risk over the federal Treasury rates. And those risks aren't going anywhere because the administration is still presenting a economic policy in such a way that it still makes things uncertain. We still find, oh, here's a tariff that's being thrown on, now we're taking it off again. Here's a new place where we're doing immigration enforcement, now we're going to move over here. All of that makes it really, really challenging for people to make decisions about their businesses and their purchasing decisions. So with that extra risk, that's not going anywhere. And if the if the 10-year Treasury isn't moving very much, you still get this gap. And so those long rates are never going to come in, even if the federal funds rate comes down. What does change, though, as that federal funds rate comes down, is the amount of cash that is available to be lent out. Right now, with the federal funds rate very high, the short end of the yield curve is was very close to the long end of the yield curve. The yield curve was very flat. That made investment vehicles like money market funds or high yield savings accounts really, really attractive. They were really safe, and you would get a pretty good return on that money. And lots of people have thrown their money into those types of accounts or money market funds. As the Fed funds rate comes down, that's going to strip away that sort of extra amount of money that you might get on those accounts. And so that money now starts to say, hey, where can we find a little bit of extra yield? And so there's going to be more opportunity, more cash available to lend. It's just going to be lending at a very high cost. Because of that, the economy won't necessarily get spurred as much as you might hope, even though the federal funds rate is going to be coming down. All right, so let's move on to what this means for construction more generally. At Dodge, one of the things we do is we track projects from their earliest planning stages all the way through to construction start when the shovel breaks ground. One way that we sort of measure this and help our clients understand what's going on in the construction industry is we have created the Dodge Momentum Index, where we take the total value of construction projects when they first show up in our planning and tells us something about how much volume there is coming down the pike. Now, the next slide, I'll sort of look at the timing of all of that, but generally speaking, in the past, it's been about a year to 16 months that post the entrance into the DMI that we see activity come out as a start, something along those lines. It's the highest correlation between starts and the DMI. What I'm showing you here is actually a breakdown between institutional and commercial. Within the commercial, we actually exclude data centers. That's that brown line. That's where we've excluded data centers because they have been such a big lift on all construction activity in 2024 and 2025. And you can see that by the gap between the brown line and the light blue line on the left-hand chart. Okay. The other thing to note is that excluding data centers, you'll see that the institutional and commercial pipeline has been relatively flat in 2024 all the way through about halfway through 2025. In July of 2025, we saw a big jump in the number of projects that went into planning. What we noticed here is really this was across the board. It was in institutional, it was in lots of different institutional categories, it was in lots of different commercial categories. It wasn't just in one place. This is somewhat rare, but the way that I like to describe this is like when you go to a prom or a wedding and there's a dance floor and nobody's on it until usually a Michael Jackson song comes on and everybody jumps in all at once. So this is sort of the classic human behavior where nobody wants to do anything and then all of a sudden everybody's doing everything at the same time. And that's exactly what happened in about July, right? So there was not a lot of people were active. They wanted to do more building, but it was flat, nothing new. And then the policy uncertainty with the new administration coming in and then knowing that there was going to be tariffs also held everybody back. And once we saw the fallout of all of it, it took a little while before people became comfortable with the fact that we were in a new environment, that uncertainty was high and it was going to stay high. So that cost of doing business is just higher. So you have to think a little bit differently, risk manage a little bit differently. And it took a while for businesses to figure out in the construction industry how we were going to deal with that. And at the back half of 2025, we sort of had it figured out. And so we're seeing a lot of these projects jump into the queue. Now, we have to take that with a little bit of a grain of salt. So one of the reasons why I'm a little bit less excited about 2026, even though there were a lot of projects coming into the pipeline in 2025, is that a lot of those projects are taking a longer time to get through the pipeline than they used to. So if you look at this chart, what I'm doing here is by different categories, looking at the median number of months that it took to go from those earliest planning phases to start, broke that down by year, just to give you a sense of what how that has changed from the pre-pandemic era in 2019 to today. We tried to order this in sort of the biggest changes from the previous year, and you'll sort of see that multifamily warehouses are really slowing down. even if you look at some of the other categories where you might see some lower years left and right, generally speaking, that sort of pinkish rose color that is demarked 2025 is generally speaking higher than the 2029 value. In some cases, remarkably so, but in other cases, it's just a little bit higher. But the whole point is that a lot of these projects are taking a lot longer to go through the pipeline. One might argue that, oh, that's just because these projects are bigger. We actually purposefully cut it off at 500 million to eliminate those really, really large projects that might understandably take a lot longer to go through planning. So yes, we got a big boost in terms of the number of projects that are going into planning, but I'm concerned that it's going to be more like the very end of 2026, maybe into 2027, before we actually see those come to fruition. As I said, a lot of these projects are coming from the data center sector. Like Census, we have categorized data centers in offices. It's one of the reasons why offices are increasing, but not increasing too much in terms of their length of delays. We also have a problem when we look in these planning queues for data centers with some of the struggles that we're seeing. And I'll talk a bit about what some of the headwinds that data centers specifically are running into. But the key point here is that it's taking a lot longer for things to go through the planning pipeline, and we're also seeing it take longer in the construction process as well. That was particularly true in 2025. There are lots of different reasons. It's idiosyncratic across the country. In some cases, it's supply chain. In some cases, it's labor shortages. And in other cases, it might just be regulatory. It just takes a little bit longer to get all of the proper checks done throughout because there are so many big projects being done all over the country. So the last few slides, I'm going to sort of dive in a little bit more into a couple of different sectors and talk just very broadly about some of the trends that we're seeing. Excuse me. The first of which, of course, is what's actually happening with construction spending. So Dodge generally is focused on construction starts, which is the full, and the way we do that is we give the full value of the project in the month that it broke ground. However, for many firms, what actually matters is when that construction spending actually happens, right? So you've got a $20 million project, you don't spend the $20 million on day one, you spend it over the lifetime of that project. The census refers to this as construction put in place, or construction spending. And this sort of shows the spending over time. Here we're also sort of seeing a slowdown to perhaps a stalling out of the market over the past year or so. Construction put in place in nominal terms is lower than it was in 2023, and in real terms it's much lower, right? So real terms meaning controlling for inflation. This is along the lines of what I was just referencing, that not just projects going through the pipeline are going slow, but once they're going to construction, even if the value of spending of starts has gone up, the speed at which those starts are going through the construction process is slowing down. Otherwise, we would also see these spending numbers increasing over time too. Okay, so we've sort of got this weird situation right now where things have slowed down through the pipeline and in construction. There's now a buildup of activity. It's going to come out, but when it comes out, it is really up for debate, and how much it's actually going to lift to this important number, which is construction put in place, is pretty dubious. So particularly given all of the information that we're going to be getting in the middle of the year, that puts us in a little bit of a hard spot in terms of trying to figure out what the forecast is going to be in the back half of 2026 into 2027. So even though we have a strong DMI number, we're cautiously optimistic, but we want to see some hard evidence that those projects are really going through the pipeline before we really start pushing on our long-term forecast. For now, our forecast is relatively flat, a few areas of strengths, a few areas of weaknesses, but on average, relatively flat, more of the same from 2025. A little bit more of a build out in 2026 in terms of starts, to a slowdown on the back half, and then a little bit of a rise in 2027. I want to explain a little bit about where that's coming from. I always do this by starting with our residential sector, because all the rest of the sectors within construction all depend on where the people are going. So once you know where there's the houses have been built and where the people are going, where do we think the sort of areas in the country that are going to see some benefits? To start there, we need to talk about what's going on in housing. Clearly, the biggest headline there has been the housing shortage. We, like many different shops that deal in this part of the economy, do this in a particular way to sort of get a sense of, like, how many houses do we need to add, or how, do we have enough? What's going on? This is a non-trivial exercise. We do this by looking at historical vacancy rates and then looking at what the current vacancy rate is and saying, how many houses would we either add or destroy in order to get us to that long-term historical vacancy rate within this state? And we do this state by state because there's a lot of variation across states. The speed at which states can build is very, very different. Of course, the South can build year-round, whereas the Northeast or northern states generally only build for about 9 months of the year. So there's just a difference in the way that they can do their work. In 2022, you could see there was not a single state that we saw that was oversupplied. And in fact, many of them were in an extreme shortage. This comes as no surprise, since during the pandemic, house prices jumped dramatically as people were moving all over the place, mostly to suburbs out of major urban areas, to get more breathing room. This had led to a really big spike in house prices and made it really hard for new families and new households to form and purchase homes. This still remains a problem, housing affordability. However, the shortage portion of it has changed dramatically since 2022. As you can see from this chart, the South has largely built out like crazy over the last few years. Anybody who's done any sort of construction work on residential construction knows that about the South. If you keep track of what's going on in housing markets, you also know inventories are starting to rise, their prices are coming in. So there was a ton of multifamily construction down in the South that has solved a lot of the problems and put us in a place where there are plenty of homes down in the South. That also means that, all of the other parts of construction, retail, office, streets, bridges, all of that sort of stuff, that's probably going to be on a slowdown because we don't need to be building and servicing extra people. They're all being taken care of as of now. So that's going to be slowing down. The South will be slowing down over the next, maybe not 2026, but certainly into 2027, 2028. There will be more of a slowdown on the commercial and institutional side. The states that are still in red are also some of the states that have a few interesting characteristics. They are some of the most expensive states in terms of housing. And they also, particularly in the Northeast, are the states and California where it is the regulatory burdens are some of the highest, particularly in rezoning. And that is one of the biggest problems when we're thinking about affordability. Is the best solution to that is multifamily housing. And that just means higher density, and these places tend to make that very difficult to make happen. We are starting to see some movement there. It's no surprise that these are taking longer to solve the shortage problem. it is getting there, but it's taking a very long time, and it will continue to take time. So because there still is this shortage problem, we are seeing some strength in multifamily in the first half of 2026, at least in terms of starts. The spending will also be pretty good because the back half of 2025 was really strong in terms of starts. So construction spending in multifamily should remain relatively good the first half of the year, but then will start to decline. The decline is also going to persist beyond that because of a big change in household formation. We have changed immigration enforcement stance that has changed the number of immigrants coming here. In fact, we're probably losing population as a result. Our previous assumptions about population assumed that foreign-born immigrants would still support a lot of the growth for population going forward, and that would then translate into support for household formation. If you don't have as many households, you don't need as many houses. So that means there's a lot less pressure, not just because we've already built a lot, particularly in the South, and are still planning to build more in those other areas, but also there's less pressure from a demand perspective on the housing market. And so we just won't need quite as many homes going forward. So given that forecast, that is why there's sort of a lot of downward pressure on our forecast in the long run, in years 3, 4, 5. Residential is, of course, really, really important, but one of the other main components of the market, the bright spot that everybody is talking about, of course, is data centers. This is my favorite chart on data centers. Not necessarily the most helpful in terms of construction specifically, but it is very, very cool to see where the fiber optic cables are. Those are all the white lines. Where are the power transmission lines? Those are all those yellow and red lines. And the blue is the water. And then those yellow circles are where there are existing data centers. Now, this is a little bit old. These have changed a little bit, but generally speaking, they're largely in the same places. What we're noticing is that, and everybody knows this, Virginia and Texas have gotten the vast majority of the data centers, particularly if you're talking about hyperscalers. And while everybody does pay a lot of attention to the hyperscalers and to Virginia and Texas, we're actually seeing a lot more growth in the medium to large scale data centers and not the hyperscalers as a share of all construction spending in this category. The main reason for that is that all of these companies need to make some money and return on investment for their investors. The way that they do that is they have to have customers, and they want to reduce the latency, and so they're building smaller inference centers and data storage centers closer to where all of their customers would likely be, which are all in the high density urban areas. So those are all being built as well, in addition to the things that everybody talks about, the hyperscalers for finding AI God, right? Those are going to be built. They're still going to spend a ton of money on them. That's where the flashy stuff is. But don't forget, this is a maturing industry, and they do need to make money at some point, right? So we see a lot of growth here. We actually have done a project, a report on mega projects and sort of sizing of projects over time. It's really interesting. That's where I got some of these tidbits about where the sort of investment is going. But we continue to see a lot of strength in data centers. One of the constraints here, of course, is how quickly they can build these things. That's their whole game, is speed and power, and I will talk about power next. Speed is one of the reasons why there has been so much of a build out in Texas and Virginia, because it takes about 3 months to get through permitting for these data centers in Texas and Virginia. But in a place like Colorado, which might seem very logical to have data centers since they kind of get cooled by the environment, that you don't have to spend as much on cooling, it takes about 12 months to do that in Colorado. And so it's very easy for a company to say, hey, I can't wait those extra 9 months just to get permits settled. Let's just move on. We've got another constraint coming, that there are more and more communities who do not like having data centers within their backyards. That has led to a weird dynamic where these companies actually set out, even if they just need a 100 megawatt facility, they might cite 3 of them and start going through the planning process on 3 of them because they don't know which communities are going to push back hard enough to not get through the permitting process. That makes it really hard for us to sort of figure out in the earliest stages how much of this is actually going to flow through. So that's one of the reasons why we're a little bit nervous about taking those DMI numbers, particularly for data centers, too seriously. It's really hard to figure out which ones of those will end up being the real sites that get to the back end. So we have to wait a while before we really incorporate those DMI numbers into our starts forecast. So finally, I'd like to turn to power gen. This has been another category where we saw a pretty big increase in 2025, particularly the last bit of 2025. We think it's going to continue to be strong in 2026 and 2027 because there's just way too much demand for power plants. We're actually seeing a lot of growth in solar and wind. One of the reasons for that is it's relatively easy to go through the regulatory process once you've purchased the land and can get the rights to put these things up. It's relatively quick. That's mostly what you have to do. Since there isn't any pollution concerns, there aren't a lot of regulations there. So I think that's one of the reasons why they're going very, very fast and continue to go despite some changes to incentive structures that's coming this year. That being said, if you look at the Energy Administration's website, you can sort of see the EIA, what their pipeline is, how much generation there has been, net summer generating capacity. That's that brown line. I've added on all of the projects that they had on their website from a few months ago. If all of those got added, what their net summer generating capacity would be, and you sort of see it flat lining out in 2030. Don't look at that and say, oh my goodness, we're not going to have enough power. If we just took the growth rate from 2013 to 2023 and we apply that, that would give you that light blue line, meaning that there's actually a pretty good possibility that we get quite a lot more power gen over the next 5 years. The truth is probably somewhere in between those two. The dark blue lines are forecast for power plant starts, and that's in terms of billions of dollars. That probably is on the lower end. It also will probably go up. But again, these are projects that come in usually very big numbers, right? So talking about $200-300 million facilities. Sometimes if they're really big, you can see them be in the billions of dollars. That's particularly going to be true if, as what most people suspect, we're going to start heading down the nuclear path. So that's sort of what we're looking for in power gen. Again, the next couple of years look really, really strong. Beyond that is probably also going to be strong, but it's going to take a little bit more time to get some confirmation that the supply is going to reach these record levels of demand. So this is sort of a headline of where the economy is, how that's broadly speaking influencing the construction industry. I wanted to thank you all for being here and listening to me for these last 50 minutes. If this discussion was something that resonated with you and you'd like to go deeper, I do offer one-on-one executive briefings. These are conversations where we can talk through what the data means for you and your business and your planning priorities. If that sounds helpful, please type in executive briefing in the Q&A box, and someone will reach out to you once we, all the dust settles. At this point, we're going to invite Sarah Martin on here. She is our head of forecasting, and she's going to help me with a little bit of a Q&A session for the last 10 minutes. Sarah, good to see you.
Okay, great. Yeah, nice to see everyone be here today. All right, so we're getting a lot of good questions coming in. So I guess to start, maybe we centered the conversation around data centers because you were just talking about that. What are you seeing in terms of like the sort of local pushback for data centers? Are we factoring that in, concerns around health and environmental issues, and how do we see that kind of potentially impacting our forecast?
Yeah, so that was one of the things that I sort of brought up at one point. Really what ends up happening, and one of the reasons why the data center folks are operating the way that they are, is that they operated in such secrecy for so long that, and they continue to, that communities largely would get surprised by data centers all of a sudden sprouting in their backyard. And what has happened is people have been trying to figure out whether they're coming, and then collecting as a group, as activists, to try and squash it, going to the local boards to make sure that permit doesn't go through. So it really seems to be like a last minute thing, and this is why the data center groups are sort of having more than one place where they might be wanting to site just one data center. They'll go to multiple places just because they don't know when there's going to be community activism.
Great, yeah, that makes total sense. What about, do we have any concerns about kind of stress in the private credit market and borrowers being over leveraged?
I would say, generally speaking, private credit and private equity, all of that is very, very opaque. So just because it's opaque makes it immediately a bigger risk. It's hard to know exactly what that's going to look like. Generally speaking, though, if you look at, in aggregate, what's going on with firms and consumers and all of that, in aggregate, financially speaking, most people are doing pretty well. That makes, and what I mean by that is that they are not over leveraged. So that means the system as a whole, likely, even if there is a problem in private equity or private credit, is unlikely to cascade catastrophically as we saw in the financial crisis before.
Do you think that, just given kind of the strength of that data centers and AI investment have had in our overall GDP growth in 2025, is it possible that we would have had a recession without that level of growth?
I'm not sure about recession. Again, that starts if you really think about it, the starts and spending in data centers was something on the order of $50 billion. Now, if you add that all up, that really isn't a lot. And if you also look at the jobs numbers, that's actually what most economists would look to more than GDP to sort of determine whether there was a recession or not. Almost over 90% of the job gains in 2025 all came from healthcare. It has nothing to do with data centers. So that would probably still have been there, which means more than likely you wouldn't have seen any tick down at all. So I would not think that there was a recession necessarily. The problem there isn't necessarily with the actual activity. It has to do with what's going on in the stock market. The stock market has gone up wildly because of AI and is very richly valued, and that has caused what economists refer to as the wealth effect. If you have a large pocket of store of money in the background, it makes it a lot easier for you to justify spending additional money. And so therefore, it's really easy for people to do that extra spending. And that's probably actually why we had sufficient consumption growth over 2025 to keep us relatively safe. So there wasn't more pain in the retail sector, for example.
Yeah, makes sense. What about for our hotel forecast? What are we expecting in 2026 for that sector?
So hotels, as you may have noticed in the chart that had the lags to start, it was one of the hardest hit through the pandemic, and it's been coming down in terms of the time it took to go from earliest planning to start was the worst in hotels, and it's been coming in. There are a couple of reasons. One, it took a while for them to recover from the pandemic and start spending again on hotels, and we're waiting for tourists to actually go out and about again. But the other reason that it's been coming in is because hotels have been switching to a renovation cycle. That renovation cycle, once that takes off, just because of how competitive it is, hotels tend to sort of spin up pretty quickly on that. For that reason, hotels will be stronger than they were, but not necessarily robust like they were pre-pandemic, and it will mostly be on the renovation side.
Great. And what about kind of our assumptions around the potential for nuclear power to become more important? There was also a question kind of tangentially, what are we seeing with our pipeline for semiconductors, all related to this data center power conversation?
Yeah, sure. So there are two things. One, both nuclear energy and semiconductors are both really, really big projects, right? The high value, big spaces. For nuclear, it's a highly regulated, and so it's really challenging for those things to crop up, right? Like we're only going to see one or two of them, but when they show up, it's billions of dollars, and so it matters for the forecast. We have seen a big slowdown in semiconductors. I think that will start to pick up again. I think the vertical around semiconductors is very, very strong. So chemical and all sorts of inputs into semiconductors and all the products that might use semiconductors, that vertical supply chain within the US will probably strengthen over the year. But it's still sort of sorting out whether that ecosystem has the right levels of job skill availability within the US. And so I think there's probably going to be a slowdown, at least in semiconductors specifically, as we skill up the labor force to be able to actually work in those facilities. And then there's the nuclear side of things, which again, it's clear that that's pretty much the only way to solve the problem of how much demand there is for power without going too crazy with fossil fuels. The main reason why you wouldn't want to go with fossil fuels and go for nuclear power instead is because, one, you get a very large output that is relatively speaking safe, but also it doesn't take as much to get those things started once you move down the line. We've come a long way in terms of our ability to create and maintain these structures. I mean, we haven't done it in the US for a long time, but worldwide, there's been a lot of learning around this industry, and we probably could do a pretty good job of really building out our capacity with that. I guess we're at time. I'd like to thank you all once again for joining us today. Before you go, I'd like to just take a moment of your time to do a survey. We will send that around. Your feedback helps us understand whether today's session was valuable and what topics you'd like to hear more about in the future. I think I saw a few of those pass by as well in the Q&A. And as you should know, we will reply to the questions in the Q&A box, via email if you didn't get your question answered live. And if you're interested in learning more about how Dodge can support your planning and growth goals, there's also an option in the survey to raise your hand for a follow-up conversation. So please make sure you do that survey because you might actually get some more details from us. Thanks again for spending some time with me. We hope to see you again at a future Dodge webinar. Bye-bye now.